In this month's economic update, Kaplan Professional Education's Trevor Trahan speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Trevor Trahan, and this month I'm speaking with independent consultant Don Stammer. Thanks for joining us today, Don.
My pleasure.
What is your view on how the Australian economy has performed so far this year?
Well, certainly the pace of economic activity has slowed. In fact, you could describe Australia's economy at present as lacklustre. That's not a surprise given the big decline we've had in mining investment and also the big drop in our terms of trade. It's a fairly challenging time for Australia. Looking ahead, it's still my view that Australia will avoid recession this year. I think there'll be enough return of confidence. Also, it's fair to say that things are a little bit better, even though they're grim and lacklustre, things are a little better than a lot of business feared at the beginning of the year. So there's one or two hopeful signs, but basically it will go down as a year of 1.5% to 2% real growth in the economy, less than that in growth in national income. So a challenging year for the Australian economy, but not a recession.
What are the main issues which still need to be resolved so the Australian economy can improve moving forward?
Most important one is confidence. Confidence of households, which incidentally seems to have picked up a little bit in the last month or two, and confidence of business. What would help with the confidence of business is the government being able to deliver a budget in May and seeing signs the Senate will allow the main features of that budget to be passed. The impasse with last year's budget, the poorly thought out budget last year, certainly dented confidence. So what we need in Australia is signs of better confidence for business, somewhat better confidence for households, and there are signs of those things happening. Moreover, what Australia needs is some better news out of China. Basically, a lot of Australians and a lot of Westerners around the world have taken the view that China will have a hard landing. China takes about a third of our exports, so what happens in China is very, very important for the future of the Australian economy.
Australian business confidence improved in March. What were the main driving forces of that?
Several reasons. One is businesses had been too lacking in confidence in January and February, so things moved back a little bit to normal. Secondly, of course, there was in February a cut in the interest rate by the Reserve Bank, and that tended to make a few businesses much happier, particularly those with debts. A third thing was some of the news coming out of the US economy in March was a little better than people had thought. The US is the one economy in the world doing well. Any good news out of the US tends to help confidence here. So it was a useful pickup in confidence, but looking over the next few months, the number one ingredient is a budget that looks carefully thought through and which the Senate will endorse at least the major features of.
China's growth has dropped to closer to the 7% mark in recent times, but can we expect it to drop below that 7% rate this year or in 2016?
We almost certainly will see Chinese growth drop below 7%, but it's important to see that in context. China's GDP is double what it was 8 or 9 years ago, so 7% growth now is the equivalent of 14% growth then in terms of the additional output. So 7%, 6.5%, even 6% growth is still pretty good for Australia. It is important to note though that Chinese GDP is a fairly misleading statistic. It's probably better in China now to look at industrial production, plus retail sales, plus confidence in the services sector of the economy. They are better indicators, I think, of Chinese well-being. The Chinese do face a number of challenges. They're trying to clear up corruption, they're trying to encourage households to spend more, and they're trying to move the economy away from exports and capital spending, heavy capital spending, towards consumer spending and also on services. So China faces a number of challenges. China's advantage is it has a high rate of saving, it has a pretty strong entrepreneurial spirit, there's still big opportunities to free up business. I'm an optimist for China achieving long-term growth of 5 to 6%. I think it'd be crazy for people to obsess too much about 7% target this year because 6.5% growth outcome would still be quite good news for Australia. One other point on China, Markets around the world, particularly share markets and commodity markets, have been assuming that China's about to go into a hard landing. China has made tremendous easings of monetary policy in recent weeks. My guess is China will avoid the hard landing. It will slow, but not go into recession, and that will require some revision of attitude, revision of sentiment in investment markets and commodity markets.
Exports also fell for China in March. Will that trend continue? How damaging is that likely to be for the overall economy in China?
It's important for Australians to be aware that it's Chinese policy now to slow growth in exports and have more of China's output put to sale for their domestic economy, and particularly as part of consumer spending. Also, there's been a lot of volatility in Chinese exports month to month. Part of that because people were over invoicing exports to try to get money out of China. Those arrangements have now been analysed, and there's opportunities legally now for Chinese to move more funds out of China. So I think we should leave it another few months. Certainly the good news for Australia is Chinese exports to the US seem to be on the way up, but I do think that the very recent Chinese export figures are very much affected by changes in regulation of money in China and foreign exchange in China. I think Chinese exports have slowed a bit, but not as much as the latest numbers would suggest.
Which economies elsewhere in the world will be most greatly impacted by the more modest growth outlook in China?
Obviously Australia is the number one because so much of our exports go to China, and it's such a limited range of products, particularly energy and inputs into Chinese iron and steel production. Brazil will be affected, so will the ASEAN countries, but Australia is the number one that is affected. There'll also be some effects felt in Korea and Japan, both of which have built their exports up. The good thing though is, although China is slowing, and China certainly has an economic cycle we've all got to take account of, I think people have become too pessimistic about the outlook for China. China will slow, but not as much as is generally assumed.
What signs are there that the EU economy is likely to improve during the rest of 2015?
The most recent numbers for business confidence and production from Europe have been a good deal better than they were expected to be. Germany particularly is doing well with its exports, not only to the rest of Europe but also to China. My guess now is that, subject to there not being problems with Greece running right through the year, that Europe will achieve real GDP growth of 1 to 1.5%. Now that doesn't sound very bright, but it's a good deal higher than what happened in 2014. It's also a good deal higher than what was expected at the beginning of this year. Confidence is coming back to Europe, but it will be a slow recovery, and Europe still faces a lot of problems.
Are there any indications that tensions with Greece will be resolved at any point soon?
I think you'll have problems with Greece recurring right through the year. Certainly a couple of months ago people were too optimistic that the problems could be addressed. It was thought Europe would quite readily do a deal with Greece that gave it some forgiveness for some of its debts, delay in repayment, and all would be sweet. It's turning out to be a lot harder than that. But Greece, under the previous government, had made a number of very tough decisions. The budget deficit's been cut back, the current account deficit's been cut back. Greece still needs to do a number of things like collect its taxes more fairly and face some tough decisions. However, the problem is that Greece is a very different country from Germany, but they have tied currencies. And the whole problem of the European common currency area is that the individual countries are so different, it's hard to fit together. So my view is Greece will stay within the common currency. There will be some assistance to Greece, but even at the end of this year, people will be saying, should Greece exit the common currency? Would that be better for Greece, better for Europe? It's one of those recurring problems because Greece and Germany should never have been sharing a common currency.
What is the European Central Bank likely to implement in a bid to improve the economic situation in the region?
The European Central Bank is going flat out now with its quantitative easing, so it's committed to buying a significant number of bonds every month through into 2016. Secondly, they're committed to keeping the cash rate very close to zero, and sometimes in fact it's slightly negative. So banks are actually paid now to borrow from the European Central Bank. And all of those things have really given a boost to financial confidence in Europe. The European share market in the last 4 months has substantially outperformed the US share market because of that significant easing of monetary policy there. Now, what the European Central Bank has to do still is two things. It's got to try to convince Europeans that they will avoid deflation. There's been fears of deflation in Europe, and of course that means people put off spending until things are cheaper. And the European Central Bank still hasn't convinced a lot of people in Europe that there will be mild inflation or no change in prices. People still fear deflation. The second thing the European Central Bank and the monetary authorities generally have to do is go further in the recapitalisation of European banks. American banks have been recapitalised. Our banks recapitalised in the worst days of the financial crisis back in 2008 and 2009. But a number of European banks still have very skinny capital. They basically need to put a lot of effort into recapitalising the banks, because the lesson of Japan in the 1990s was easy monetary policy is all very well, but if the banks are not recapitalised and lending, you don't get a worthwhile and lasting recovery.
We have witnessed weak US jobs growth in March. How will this impact the US economy at large?
Certainly the job numbers in the US in March were weak. The figure was 126,000 jobs, new jobs were created net. Now, the figures had generally been running at 200 to 300,000. 1 month's job figures should never be relied on too much. It's important to look at the trend. But certainly the strong US dollar is going to trim a little bit the jobs growth they would otherwise have expected. My view is the US jobs growth will not be a problem. Unemployment's fallen down to 5.5%. The central bank in America now describes the US job market as strengthening. And I think the US economy has a momentum that means job growth will pick up.
What is the latest on the US housing market?
US housing prices have increased quite a lot since their low point in 2009. However, the rate of increase in US house prices has now started to level out. The big rebound has occurred. It still means that the US has fairly cheap housing. The US doesn't have the problem of housing affordability that really is a worry in Australia. So house prices have picked up, now levelling out. On housing starts, the numbers are similar. There's been a big recovery from about 600,000 houses a year being built to about 1.2 million houses a year, but there's not the strong increase in housing starts that we're seeing in Australia. So overall, the housing market in America in both price and in construction is moving back towards more normal levels, but certainly the big increases we've seen since the financial crisis are now levelling out.
What is the best result the overall US economy can hope for during the rest of 2015?
The best results for the US economy for the rest of 2015 would be growth of about 3%, and given the return of consumer confidence and given how cashed up American business is, that's achievable. Also, the best result for the US economy would be that inflation remains at the negligible level it's been at. My guess is the growth figures for the US, the growth forecasts are quite robust, but there's a lot of uncertainty about inflation. Inflation is very low, and of course that's brought US bond rates down below 2% yield. It would only take the slightest hint of inflation coming through in America. You'd see bond rates pushed up, you'd see pressure on the US central bank to raise the cash rate more quickly and in a bigger way than is currently expected. So I think the year will be good for the US growth, even with the stronger US dollar. Probably inflation will remain very low, but keep a watch on inflation, because it would only take the smallest move up in inflation to change expectations in the bond market and expectations for the central bank's moves.
Thanks for your time today, Don.
Thank you.